over the last sort of 10, 20 years, we've had new data become available. You'd all be aware that we used to have data sets, from Kenneth French since 1926 for the US stock market. But various researchers, led by Professor Gottsman at Yale, have pushed that back to 1826. Long, long way. They've gone through the old records, prices and dividends. And because we have dividends, we can construct style returns. So we can see during what episodes in the past did high dividend yield sort of value stocks do better or worse than a low dividend yield growth stocks. And what comes out of it is that the outperformance of value that is there since 1926 has been going on for almost 200 years. It's almost a straight line if you look at it on a log chart. 56,000% I think it is now, but more informatively about 3% odd per annum over that time. What it has also shown though is that big drawdowns are actually much more common than we might have thought given on the history that we had up to now. So in some ways that post-Second World War period of economic stability and prosperity was probably a little bit unusual when you see it in the longer term context. So the returns are not as consistent in that sense as you might have expected. 90% of the time, value was in some sort of drawdown, despite the fact that it ended up 560 times higher by the end of the period. And a third feature that we've noted is that value drawdowns tend to follow financial crises. That happened with the 1841 drawdown, which followed the 37 crisis, the 1862 drawdown, which followed the 57 crisis. That long drawdown that peaked in 1904 was of that category as well. And of course, we all remember that the last big drawdowns for value were in the 1930s, which followed the Wall Street crash and the Great Depression. And of course, now we have the current episode, which followed the GFC. That's an interesting new sort of observation, although you can't be, even now the data isn't enough to be really categorical about it, obviously. And lastly, I thought I'd like to talk a little bit about the longest drawdown and the deepest of them all. Because, as you know, until sort of late 2020, value stocks in the US had underperformed for something like 12, 13 years in the US, and it had been really quite severe. Well, this has happened before, and it happened from 1890 to 1904, a 14-year period. And I just want to describe what happened then, and you can sort of, in your own mind, tick off the analogies with today. It happened because there was a financial upset before that. There was a debt overhang. There was widespread deflation in the US because the US was on the gold standard, and they couldn't increase the gold supply, despite the fact the economy was growing quite strongly. So there was deflation, which put a lot of pressure on people with debt. The small farmers, the workers did badly. There was rising inequality and rising social tension. And there were two actors that were on the scene who were sort of the main protagonists politically. One was William Jennings Bryan, who represented the little man and the small farmer. He became the presidential nominee in 1896. And he gave the famous Cross of Gold speech that you'll still see referred to sometimes by people who study monetary theory at the Democratic Convention. He was up against McKinley, who was a very aloof character. He represented the money interests of the East Coast banks who wanted to stay with gold, while Bryan said we should allow silver. It's called the bimetallic question. And if you're a fan of The Wizard of Oz, the story has various references to this debate in the story. If you know where to find them. In the 1996 election, Bryan lost, McKinley won, and they recontested that in 1900, and again with the same outcome, McKinley won. So the process was allowed to run. There was deflation, there was pressure on people, there was rising inequality, and there was also the rise of various industrial monopolies that McKinley didn't do anything about. Northern Trust Railway, Carnegie's US Steel, Rockefeller's Standard Oil. But McKinley was assassinated in his second term, and his vice was Teddy Roosevelt. And Teddy Roosevelt then won his own election in 1904. And that was the third Republican win, but while the Democrats kept on losing the election, they won the debate. And when Teddy Roosevelt came to office on his own terms, he took antitrust action. He had much more progressive policies. And around about the same time, the South African mines that had been discovered in the late 19th century, Witwatersrand and so forth, were really ramping up production. Interest rates, which had fallen to 100-year lows, started to recover. There was reflation, to use that term again. And the underperformance for value, which had reached 60% over 14 years, so it was very painful, ended then. Over the next 4 years, value valued 140%. And the old sort of era was swept away and replaced by that, by the new. And of course, the various analogies are fairly obvious to what we have today in terms of rising inequality, some monopolies that dominate the stock market, and now we've had the election of President Biden. Clearly, the prospect for more redistribution, for more progressive policies, for perhaps antitrust actions seems much higher. Look, the first thing I'd say is we can't be sure we're at a point of inflection. But I think the probability that we are is much higher, and markets are also telling us that. And the reason for that is that up to now, what central banks did, they instituted QE. That is, they increased base money, which ended up as excess reserves by the commercial banks with the central bank. It never flowed out into the wider economy, which is why broad money didn't increase very much at all. So in Japan, for example, which was always the conundrum, if you will, they did a lot of QE, increased money base a lot, but it never went into broad money. This is not QE, this is MMT that is happening today. So it is fiscal and monetary working together. It's monetization of deficits. And this time it is checks with households. The money is now in the community. So in that sense, this is not QE, which was really for Wall Street and the banks. This is for Main Street. So the differences are quite stark in that sense. The quantum is also very large. The US ran a 15% of GDP budget deficit in 2020. And it seems like it may even be larger in 21. So it's not changing. There's not much move to austerity, as it's now called, in the US. It's very large, and we've seen already, by the end of 2020, broad money in the US was up about 25%. Which, if you look at the chart from the long run, it's a hockey stick. We haven't seen that pretty much ever. By the middle of this year, I think we will have got to over 30% from the start of COVID. What that means is that today already, around the world, 1 in every $5 in circulation was created since March 2020. By the middle of this year, we'll get to 1 in 4. And that has consequences. That is a lot of new money. So in that sense, this is different to the old QE, and this is why it may be a turning point, and perhaps also why things like the break-evens in the bond market are telling us that they are pricing a different future inflation rate than they were 6 months ago. If you look at at past cycles and how long they run, and I presume you to put that into context, in the US, the drawdowns run for 12 years. And was quite extreme. So in that sense, history suggests that this is a multi-year event if it does unfold. And look, we're now 2 quarters into it, so perhaps it's too early to count chickens. But if there is reflation, if the environment has changed, it will take a fair while, because there is some extraordinary pricing on the other side. So there's a lot of air to be let out of a bubble on the other side. So in that sense, I would expect it to go for much longer. In a worst case scenario, if there was inflation, it would probably happen in an almighty hurry in the context of a very rapid falls in the market overall. I don't think it would make any outcome, any difference to the long run outcome, whether it's fast or slow, but that is one thing that could accelerate it if there was an actual rise in inflation. In the past, we've sort of been known as being very wary of banks, but they peaked with very high valuations in 2015, and then they underperformed almost continually 5.5 years running, and they got to really quite good valuations in the second half of 2020. And we achieved the remarkable feat of being 26% underweight banks in 2015. Astonishing that you could even do it. But that was completely wiped out by the end of 2020. We bought into the 4 non-com bank major banks. And really the reasons were mainly the valuation, right? From very optimistic expectations, they'd become very pessimistic. They were trading at book value, so that in that sense the decision was fairly simple based on valuation. Now, the environment is clearly turning out to be yet better than we think, almost month by month. And clearly there is still some good news in the banks. The multiple reversion has really mostly happened. I think that train has left. But there's a bit of upside from, if interest rates do eventually rise, there will be some restoration for the net interest margin. And if we do get reflation, then you can also sustain higher long-run credit growth rates because nominal GDP is faster, both of which will clearly help. But sort of get back to the earlier discussion about secular stagnation, reflation, inflation. They have very different outcomes, those three scenarios for banks. I spoke about the fact that reflation is much better than secular stagnation. Inflation is much worse. Because clearly, if there was a serious outbreak of inflation, the central banks would have to raise rates and more or less deliberately crash the economy in order to overcome those inflationary forces. So it's very important to watch that very carefully. At the moment, I think the banks have very clear air ahead of them. House prices are fine, rates are low. We already know about the margin pressures that can write some of the provisions they took in 2020 back through the credit line. So at the moment, the outlook is good, but we'll be watching it very carefully. And if they continue to rally, I expect we'll be selling them over 21. It's reasonably simple. Westpac and ANZ are the most attractive. And there's not that much science beyond the multiples being clearly lower. NAB in the middle, Combank looks quite expensive. I mean, Combank is on 20 times forward, which for a bank is an astonishing number. It's really, on the multiples, one of the most expensive banks in the developed world, if you look at the global universe. Now, we believe that Commonwealth Bank should trade on a small p premium to the peers and quite a significant price to book premium implied by that to the peers, but the current premium seems extraordinary. Yeah, look, I mean, we were very concerned in 17 when there was a very strong boom on. We remained concerned in 18 as prices started to fall. We were rescued by the outcome of the unexpected election in 19. The biggest risks come when a market goes from a boom mentality to a bust mentality really, really quickly. If it happens very slowly and people have time to adjust and the loans season, that takes a lot of the risk out. So by the start of this year, you could look back and prices in Australia hadn't gone up for 3 years. Gone sideways a bit, down and up a bit, but they hadn't gone up dramatically. And it was very clear that anybody who was overly geared and perhaps really extended would have taken corrective action in 18, 19. So a fair bit of the risk probably came out. On the bank side, obviously the lending standards had improved after all the spotlight that was put on them. So a lot of the issues that were current and could have turned acute in 17, 18 into 19 were much older. And now, of course, we have a lot of household support, very low interest rates. So I think for the next year, the question is only about how much do prices rise and will macroprudential tools again be necessary to stop the rise. Doesn't mean the debt problem per se has gone away. And if the world went from reflation to inflation, it clearly would be an enormous problem. In New Zealand, they already have. I don't know whether you saw that, because Auckland prices were shooting up, so the RBNZ has already done that. The RBA gets asked the question a lot at their meetings, and the speeches with the public. And so far they have said that they're monitoring, but they're quite happy. I suspect that those people who say that prices will be very strong are probably right, because not only are interest rates very low, but there's a lot of cash from the stimulus, both here and in the US, that is still sitting with households and that will start to get deployed over 21. But there's also a reason for expecting that the inflation pressures may not disappear very quickly. So I think house prices may turn out to be very strong in 21. And I would expect the central bank to take action on that, because the last thing we want is yet higher prices and yet more debt, because if rates ever have to go up, it is obviously a problem. So I think it's a very sensible way of doing it, and they may well target things like higher LVR lending, high debt to income lending and so forth, which is, I think, it's a much finer tool to use to stop developments in a particular market rather than raising rates, right, which is a very blunt tool.